All right, we're going to let everyone jump on here. We're going to start our presentation. All right. So my name is Aaron Fragnito with People's Capital Group. We're going to talk today about two properties that we purchased and renovated, and we're working on refinancing and producing cash flow to our investor group. And as we go along here, if there's any issues with hearing me or seeing the screen, you should be seeing the presentation right now. You should see a screen that says Live Update, People's Capital Group Apartment Building Repositions, 2 current case studies. So you should see that. If you have any issues, just type them in the Q&A. If you have any questions as we go along, please type in the Q&A as well. The Q&A is, if you put your mouse over the Zoom box or the Zoom thing there, the Q&A will pop up. And you can type any questions in the Q&A as we go along. So I really encourage your questions. I love questions. So write them on in the Q&A there, and I will answer all the questions at the end of the presentation. We're not going to go that long tonight. This will be about a 30, 40-minute presentation. Probably won't go the whole hour. So we'll leave plenty of time to do some additional questions there. And we'll talk about 2 properties here. Quick disclaimer, this is not a solicitation for investment or capital. This is not tax advice or legal advice. It's for informational purposes only. Of course, consult with your CPA or attorney before making any investment decision. And People's Capital Group is not a licensed securities broker, and we only work with vetted and approved and qualified investors. We'll go over that process towards the end of the presentation, how the type of investors we work with, and the process to get qualified. All right, so tonight's agenda, we're going to focus on 2 properties. We're going to focus on an 11 unit that we purchased in Patterson, New Jersey on Summer Street. Need a lot of work, and we're doing very well on that one. And we're also going to focus on another case study, 196 9th Street, Passaic. So 2 towns right next to each other here in North Jersey. And that's a smaller property, 6 families. We'll talk about 2 kind of smaller scale syndications here in the grand scheme of things, and how we found the property, how we analyzed it, how we put together the investment, how we structured it, and of course, how we repositioned it, lowered our expenses, improved the rent roll, and we're able to produce cash flow and refinance equity for our investors here. So tonight we're going to talk about the process of each property, and we're going to really break it down. Well, let's start with the 30,000-foot view here, kind of how it works. I see more people are jumping on as we go. That's always good to see. Again, if you have any questions to go along, put them in the Q&A. And so here's what we do at People's Capital Group. We buy properties. Step 1, we purchase a discounted property using leverage. So we look for anywhere between 6 to 50 unit apartment buildings in North Jersey and mixed use properties. Mixed use means there's storefronts on the first floor and apartments above it. So we focus on those 2 things, apartment buildings and mixed use. Our theory is that people are always going to need a roof over their head. And that theory has proved pretty true through the years. And we see that the demand for housing continues to grow, the rent continues to grow, interest rates continue to stay quite low. We'll talk about how it's really a good environment as well to be buying real estate right now and owning real estate, income real estate at least. And so that's our first job, is step 1, purchase a discounted property using leverage. We'll do tons of direct mail marketing. We'll use our network. We'll use our dozen years of experience, our networking group of over 4,000 people, realtors, wholesalers, brokers, to bring us these deals, our relationship with landlords and other real estate investors to source these deals. And then we go ahead and we strike on the opportunity, buying the property for a discounted price, using a mortgage to then leverage our investors' capital. And we're going to break this down through 2 case studies tonight. Step 2 is then we improve the units, we increase the rent roll, we lower our expenses. This isn't rocket science, right? We're buying mismanaged properties. We're going to do as minimal renovations as we need to get the properties up to code, to get the properties to lease for the top dollar. And our goal is to keep our costs low, but improve the units for maximum value so that when we show them to new tenants or even existing tenants, they understand why the rent is changing, or new tenants understand why the rent is fair market value. And so we're able to improve the units for a lower cost using contractors we work with for years, using our in-house management company. We lower our expenses as well. And that we also work on increasing the rent, renegotiating leases, and finding out more ways to make income on the properties through storage and parking and laundry and things like that. So we form more streams of income through the property as well as in renegotiating the leases to top dollar. Step 3, we create positive cash flow and create a cash out refinance. So we're going to talk about that tonight, how we create cash flow for our investors from the property, that pays out on a quarterly basis. And then we aim to do a cash out refinance every 4 to 5 years on the property by forcing value into the property. That's called forced equity. That's by increasing our rent, lowering our expenses. We force value into the property, and that allows us to do a cash out refinance, and that allows us to deliver a lump sum of capital to our investors and also give them exit options at the cash out refinance. So just getting your entire investment back and exiting the investment, keeping the cash earned from the refinance, keeping the cash earned from the cash flow, but of course having some type of tax burden in that case. So a better strategy is to not exit, stay invested long-term with us. And we actually plan on doing a 1031 tax deference down the road with a lot of these properties. And we have a very long-term view of real estate. We feel if it's cash flowing and it's valued in a high demand market, why sell it? So we continue to cash flow and refinance on it. And then we also feel, well, when it is time to sell the property, we've exhausted a lot of the tax depreciation. Why get nailed on taxes? Do a 1031 tax deference and trade into a bigger building, defer all taxes. And that's an option we have. That's a strategy we have with these properties. And that's really a strategy I don't see other syndicates doing. Most syndicates only want to be working with you for 5 to 7 years, maybe 3 years. And that could be good. Maybe you're buying an apartment building and flipping it. That could be great, but you're going to get hit pretty hard on taxes. And we prefer to keep our money and not give it to the IRS. So therefore, we execute a buy, renovate, refinance strategy with our investors. And of course, they have exit options along the way as well. All right, so here's our team, PCG Property Management. We have Seth Martinez on the left there. Seth runs the New Jersey division of People's Capital Group. He completes the due diligence on many, many apartment buildings to narrow it down to one good deal, talks to owners for long periods of time to build rapport and negotiate a good price on their real estate. And he oversees the New Jersey management as well here with PCG Property Management out of Berkeley Heights, New Jersey. And he also does general company oversight as far as reviewing the numbers and books and always making sure that we're getting the best costs on insurance and that our systems are always improving. Our costs are always being as low as possible without affecting our performance, of course, and our strategies. And Seth focuses on building out the New Jersey department here at People's Capital Group. There's me, Aaron Fragnito. I look pretty young in that picture. Should I get an updated photo over there? So I'm in charge of the Vermont acquisitions. We focus on short-term rental properties in Southern Vermont. That's one of our specialties. This presentation is not going to talk much about that because I'm actually doing another presentation in August that's going to go over our short-term rental properties. So you can sign up for that at peoplescapitalgroup.com. And that's going to be a similar presentation, but that's going to be focused on short-term rental properties in Southern Vermont. So that's what I focus on up there. I'm also in New Jersey a lot as well, working with Seth and Lena and the team here down in Berkeley Heights on our New Jersey acquisitions, our New Jersey repositions. And in New Jersey, we focus on small to mid-sized apartment buildings in North Jersey, in Paterson, Newark, Elizabeth, Jersey City, Passaic. And tonight we're focusing on a property in Paterson and a property in Passaic. I also complete due diligence on all the properties. I oversee the Vermont management, Dagny International LLC, and I also focus on the fundraising. So if you've invested with People's Capital Group, maybe you're one of our current investors in one of our projects, maybe an apartment building, maybe a short-term rental, then you probably talked with me and met with me perhaps in person and maybe got to know me a little bit. So I focus on investor relations. I really try to educate and work with our investors and teach them everything I know about real estate. And let them really understand what's going on with their investment, with the property they've invested in through monthly updates that are very in-depth and really educate our investors as they go. Quarterly financials that are completed by our professional CPA here, Robert Grulich, and a bookkeeper as well that works out of that CPA firm. And so we make sure our investors are very well communicated with financials, with information monthly, with monthly updates, quarterly financials, of course, quarterly cash flow checks. And there's Lena Delgado. Lena's an amazing property manager. She's been with us for over 8 years now. She's a manager of the property management company, PCG Property Management. So she's really the boots on the ground, managing our contractors, managing all of our service providers, doing the leasing as well. She's also in charge of the general office management here in Berkeley Heights, New Jersey. So Lena's really one of our all-star players here. She's a big part of our company. And she's been a very incredible asset for us for many years. You've probably met her if you've worked with us before in the past as well, or come to the office here for an event. And if you haven't, you can contact us and get qualified and set up an appointment to come in and meet us. There's Robert Grulich. He owns his own firm. It's Grulich Hoekstra's accounting firm. And so that firm does all of our accounting, tax filing, bookkeeping, tax preparation. So a complete separate third-party company that we don't own, we don't manage, does all of our tax prep, does all of our bookkeeping, does all of our financial preparation. So there's a serious separation of powers here at People's Capital Group. You have the three people on the left, PCG Property Management, Aaron, Seth, and Lena, who are People's Capital Group. We're running People's Capital Group day in and day out and giving it everything we have. And of course, then we have Robert Grulich, who's a CPA, third-party CPA and extraordinaire and bookkeeper. And he's very good. And really, it plays almost a CFO role at our company without officially being a CFO in a lot of ways. So it's important to have that separation of powers. It's important to have those specialties, because Seth and I and Lena, we're not bookkeepers, we're not accountants, we don't, we're not specialists in that department. We understand it, but not to the extent, of course, that they do. So you always want to outsource to the professionals. Property management, right? I'm not personally a great property management. I'm not great at running around and collecting the rents and dealing with the shenanigans of the tenants. So I've always outsourced that to people that are more patient with that, better at that, more analytical, more type A, where I'm more of a type B. I'm better with investor relations, public speaking, and overall big picture execution. So you want to know your strengths in any business and your weaknesses. And you want to always, of course, outsource your weaknesses. So here we have a 463, 465 Summer Street. Okay, so this is our first case study here. And we're going to talk about how we found the deal, how we structured it, and how the project's going right now. So first of all, great deals are not created. I'm sorry, great deals are created. They're found. They're not found. So when we find a seller that's selling a property, he doesn't come right off the bat and say, hey, I'm going to sell you my property for a great price. It doesn't really work like that. Sometimes you get lucky, but especially in this market, that's not how it works. So great deals are created, not found. That's the right way to say that. We work with these sellers for years. I'm going to show a timeline in the next slide or two, and that's going to show the timeline of how we acquire this. It takes years sometimes talking to these owners, building rapport, convincing them why we're the right people to buy their property, why we're not going to waste their time, and in turn, why they need to give us a decent price because we're serious buyers. They're not going to waste their time. So we found this owner by direct mail. That's one of our best resources for finding opportunities. We also find deals from realtors and wholesalers and our network in general, and past landlords we've bought properties from, past investors. And so we were direct to the owner. There was no brokers involved. It wasn't on the MLS. And that's really how you find the best deals. And generally, if they're sitting on the internet where everyone can see it, it's harder to get a great deal because you're going to have competing bids. So you want to be direct to the owner, and we were in this case through our direct mail system, which costs thousands and thousands of dollars a month to be effective. This is an old owner. He was difficult to negotiate with. He did give us a decent price kind of off the bat. And we found some issues with the home inspection and tried to renegotiate and then found out, oh, the green card's not up to date. We tried to renegotiate. And his response always was, you don't want it? Say, take it or leave it, right? You don't want it, there's the door. So, and that was kind of it. He's kind of a grumpy old guy that just, that's it, there's the door. So we ended up getting the property for a good price, but he was tough. There was a title issue. He had done something really silly with title, and it was in the wrong person's name, and that took a long time to get fixed. So really took a lot of patience with this seller. And that's what Seth Martinez, my business partner, is really great at. So he has the patience to work with these individuals and build that rapport, negotiate a good deal, build that trust, and let the seller know that we are the right group to go with. We are the right buyers. We do have integrity, and we've done over 250 real estate transactions together. Seth and I, we own about a $17 million real estate portfolio and about 116 units. So we're able to communicate with these sellers on a level that they understand and explain, hey, we are the real deal. We buy real estate 6-7 days a week. That's all we do. And we are here to buy your real estate. So let's talk about a serious price. Let's talk about the price you give to the guys that are going to really perform. And of course, that doesn't always work. In fact, it usually doesn't work. Usually they say, no, I'm just going to go with the highest bidder. But rapport is what it's all about. And sometimes you get lucky too. So this didn't have a green card. It had lower rents and needed work. And we got it for a good price. It's 10 apartments and 1 storefront. You see from the front there, it's actually 2 buildings. The building to the left, and this is an ugly picture of it. It's just to show before we bought it. It needed work. To the left is a little stucco building. That's 2 units there. To the right is 9 more units there. Storefront and 8 apartments. Okay, so in total, it's 11 apartments, 10 apartments and 1 storefront over 2 buildings there. All right, so here's the acquisition structure. How did we structure the LLC that's created by the property? So first thing we do is create an LLC that's created just to own this property. All of our properties are owned in separate LLCs. We do that for a number of reasons: tax purposes, liability reasons. If someone slips and falls in Summer Street, they can only sue 463 Summer Street LLC. They can't sue all $17 million of our assets, ideally. So essentially, we have separate LLCs for all that, of course, and that also is because we have different investors for each group or each asset. So in this situation, we had, I think, about 9 investors participate in this opportunity. And, the other property we're going to review has a whole different group of investors. So, of course, different LLCs help separate those acquisitions out and make it much cleaner and simpler to structure. So 42% was owned by People's Capital Group of the LLC. 58% was owned by the passive investors, the non-voting members of the LLC. Seth Martinez and I are the voting members. We are in charge of running the operations day to day. And it's important that in a syndicate, not everyone is voting on what color to paint the hallway, because what happens is the hallway never gets painted. So if you have too many cooks in the kitchen, things don't get done. You want professionals to run the job professionally. That's what a real estate syndicate is. You're essentially investing in a group of professionals that are going to take your capital and then put it to work, leverage it with a mortgage. Seth and I will personally guarantee the mortgage so our investors don't have to. And we'll work with our investors' capital. We'll split up the ownership of the LLC. We'll personally guarantee that debt so the investors don't have to take that additional risk. And then, of course, day in and day out, we're going to execute on the reposition, execute on creating cash flow, improving the property, renting it out for top dollar, lowering expenses, and completing a cash out refinance over about a 4-year period. We raised about $406,000 for this acquisition. We filed a Reg D 506B with the SEC. We did a 506B because we had accredited and sophisticated investors. I'll go over that towards the end of the presentation. And of course, Seth and I acquired a $723,000 mortgage at a low interest rate, and we personally guaranteed that debt so our investors don't have to. Now, if you've bought a home or you bought an investment property, you got a mortgage on it, you probably had to personally guarantee that mortgage. So that means you owe the mortgage, whether the property burns down, you forgot to get insurance, or the property's foreclosed on you, you still can owe that mortgage. So personally guaranteeing debt means you're really committed to the investment. You personally are on the line for that debt. So Seth and I personally guarantee the debt. Our investors don't. But we make sure that to take that risk off their shoulders. It also allows us to get better terms in the mortgage, lower interest rates, lower closing costs. So here's the timeline for 463-465 Summer Street in Paterson, New Jersey. The project is ahead of schedule. In January 2019, Seth first connected with the owner of the property and started building rapport. That was January 2019. He first made the connection through thousands of dollars of direct mail and going through hundreds of bad leads, finally made a good connection with a good lead. Then a full 7 months went by. July 2019, the seller signs the purchase contract for $965. He was not easy to negotiate with. He didn't want to take the price for the longest, he would not go below $1 million. And you just got to be patient. You can't reach with these guys. You can't show your desperation. It's a staring contest. It's really about being patient and continue to negotiate. We constantly have tons of irons in the fire, negotiating, sitting back, not being desperate, trying to work with the sellers, trying to get the right price. And that's exactly what happened through those first 7 months. All right, let's fast forward then to June 2020. So pretty much a year later, a whole 11 months later here, after delays from a seller title issue, People's Capital Group closes on the property. So first of all, the seller had transferred the title to his ex-wife's name to avoid taxes at some point, and had to like transfer it back. It was a really confusing title issue. I can't even properly explain it probably in this presentation, so I'm not going to even try to. The title company took care of it. And it's really interesting, you know, how in-depth title can be, how complicated it could be. And this guy kind of tried to pull all these tricks and convince us to, you know, buy the property without the right title work and everything. And of course, we would never do that. So really, little bit of a trickster, this guy, and he kept on trying to pull the wool over our eyes and, you know, sell us a bad title essentially. So we had to get title cleaned up. We had to get his whole situation cleaned up. He had to end up paying some taxes at the closing and some property taxes, which he was trying to avoid, and it all worked out. But boy, convincing this guy that it was his responsibility to pay his own property tax took 11 months. And then there was the title issue and everything else. So very challenging there, because of course we raise the capital for these opportunities starting when we get it under contract. So in July, the capital started to be raised, and it was raised a few months thereafter. So of course our investors were ready to invest, and this was very difficult for everyone to keep delaying the closing there. And of course I communicate with our investors all through the process. And you know, I understood that one investor had to go a separate way, and that's what happened. So luckily we have a pool of about 50 investors. Our last opportunity got funded in 7 days. Opportunity before that got funded even quicker. So we are usually able to fund deals very quickly. We actually, the hardest part of our business is finding a good opportunity. We really have more investors than opportunities. And I'll go over the process at the end of the presentation, how you do get qualified to get on that list. So we closed on the property on June 2020. And then, of course, began renovations shortly thereafter. By July, we were in the midst of repositioning the property, which we projected to be about a 2 to 3 year project to get the rents up to where we wanted them to be, whether through negotiating cash for keys with tenants, or renovating units and renegotiating leases with current tenants, really a combination of both, and of course lowering our expenses as well. So we began that in July 2020, expecting about a 2 to 3 year project, but by June of 2021, we're ahead of schedule and nearly complete. So this is a good project for us. We'll probably finish it ahead of schedule here. And just about a year later now, after we started our renovations, we are looking very good. Okay, here's the numbers. So reposition performance. Hopefully you can see my screen here. Again, if you have any questions as we go along, I see more people have jumped on. Always good to see. Please type it in the Q&A. The Q&A will pop up if you put your mouse over the Zoom thing, and that'll allow you to type any questions as we go along here. So you can see to the left are before and after pictures. I don't think that's the same exact kitchen, but you can see how in this building, the kitchens were a mess. And you can see we just gave them a nice facelift, new cabinets, new countertops, fresh coat of paint, fresh floors. Some are worse than others. But we're really not about knocking down a building and rebuilding. We're not doing gut renovations. We look for lipstick on a pig, cosmetic renovations. Less is more, right? A lot of these guys that buy real estate, they do too much to it. You really just have to do enough to get the property up to code, make it look nice, smell nice, and rent for the top dollar. We're not renting here in downtown Hoboken. We're not going to give all the highest end finishings. You know, you have to know your demographic, know your rental price, and renovate to that quality. You, of course, always want a good quality apartment that's safe. You want everything that needs to work. Everything has to be up to code. You don't, problem tenants, issues with heating, plumbing, electric, all those have to be fixed. But you don't have to do the most expensive cabinets and appliances and flooring. And, obviously the contractors we use are contractors we work with for years that give us really good prices on things. So it's all about keeping your costs low on these projects, as well as renegotiating leases for top dollar. But, a penny saved is a penny earned. And it's very important to keep that mindset when doing any type of construction. So our initial rent roll, when we bought the property, the monthly rent roll was $10,900 per month. Our target rent roll was to increase the monthly rent roll to $13,800 per month. Okay, so increase the rent by about $3,000. So our current rent roll after 1 year is up to $12,700. So we're ahead of schedule. We're about 2/3 of the way there, but we're only about 1/3 through the timeline we gave ourselves. So I'd say we're about 30% ahead of schedule on this project, roughly. That's good. Our construction budget was $96,500. For an 11 unit, that's really not that much. And we are on budget and we are ahead of schedule on construction. So one of the hardest things in real estate is buying a property and estimating what the construction costs are going to be, because you can't open all the walls. You can test things and appliances and da-da-da, but you don't really know what's necessarily going to break next year or break, 6 months after you buy. You don't really know all the dings and dents of the property until you own it. So construction can easily go over budget. People's Capital Group allocates additional capital for when our construction goes over budget. That's not the case on this property, but that does happen from time to time, especially if you're doing a lot of deals. So what happened, in any time that we go over budget on construction, if we were to exhaust this $96,500 construction budget and we were wrong and construction was going to be more than that, if that were the case, that's not the case, but then People's Capital Group would come in with the additional capital. So we make sure our investors don't get stuck with a cash call. Obviously there's a cap to how much additional capital we'll bring in, usually about 50% of the construction budget. But that just goes to show you have to go 50% over the construction budget before we do a cash call. And even if that's the case, we tend to just continue to invest capital if required. But we've never done a cash call. We have never gone back to our investor group and said, oops, we underestimated how much cash we need for renovations. We need to raise more capital from our investors. We do not plan on ever doing a cash call. The cash call is not a good thing. So when we do go over budget on construction, we bring the additional capital to the table. And that's important to have structures like that, win-win structures with your operators, right? If your operators go over budget, do they pay the price or do you pay the price? That's a good question to ask your operator. All right, so we have a 5% annual forced equity growth. That was our target, and our target was overachieved. Okay, forced equity growth is us increasing rents and lowering our expenses. See, the value of a commercial property like this is based on how much the net operating income is. Okay, the more net operating income this property earns, the more it's worth. Okay, commercial real estate's valued similar to how businesses are valued. So we figured before buying the property, we targeted a 5% forced growth year over year, okay, per year, assuming we could lower our expenses and increase our rents to a total net amount of 5% of growth, okay? That was our assumption, that was our target, and we overachieved that. So we're above target on our assumed forced equity growth. We also assumed or targeted a 1.5% natural market appreciation. We assumed the market would grow around 1.5% per year. Now, when we bought the property, market rates were growing at like, what was it, a year ago? A year and a half ago. So we're looking at, 6 to 8% at the time. And they've grown even stronger since then with the pandemic and everything. So we were way too conservative with 1.5% per year. And that's good. You want to be conservative. You want operators that are conservative. You want operators that underpromise and overdeliver. And the way to do that is to set the bar pretty attainable, right? You don't tell your baseball coach you're going to hit a home run every time you go to bat, because if you do, you're going to disappoint them. You got to understand, and there's going to be singles and home runs in this business, and hopefully no strikeouts. But we assume very conservative numbers in this business, 1.5% natural market appreciation. That's about half the rate of inflation. So essentially, the market would have to start to shrink or lose value to even be there, because inflation is growing at faster than 1.5% right now. So just naturally, if you invest in even a no demand market that doesn't grow in value, just inflation itself, you could assume a growth of 1.5% at least. So that's our assumption there, and we just assume inflation will continue to happen, which has been proven right here for sure. And that's what we see here. So we're able to do much better than that 1.5 assumed natural market appreciation, and that's allowed us to do better than targets overall on this property. So here's our total targeted returns for the investors. So COC means cash on cash return. These are our targets for years 1 to 5 for this property on Summer Street, this 11 unit on Summer Street in Patterson. We have a cash on cash from the refinance. Okay, so we're going to buy for a discounted price, renovate the property, create value in the property, force the value up, and then we're going to harvest that equity growth around the end of year 4. And we target about a 49% cash on cash return to the investors at that refinance. So about 50, about half your investment back at the refinance. So that's our goal in this investment here. I think we are going to hit it. It looks like if things keep on going the way they're going, we should not have a problem. And we also assume a cash on cash from cash flow. Okay, the building's going to start producing cash flow very soon. Now that it's mostly renovated and completely leased up. So at this point now we're looking at about a 16% cash flow from the property over the 5-year period. And that's a very conservative cash flow number. You can see most of the return comes from refinance. This is a maturity investment. These are longer term investments, about a minimum of 4 to 5 years. And it takes time for the investment to produce income. Now, not all opportunities are like this. We bought a 25 unit in December. That 25 unit produced a check in the first quarter of 2021. It's going to produce a really nice check this quarter. We just had a Section 8 owed us a bunch of money on, and the more units you have under one roof, the better you tend to do. So that's a turnkey 25 unit, right? That was a good investment, good opportunity. So this is more of a reposition. Okay, so this opportunity, this 11 unit on Summer Street in Patterson, this property needed work. Rents were way below market value. So this is a real reposition, okay, real renovation. And we're turning over units, we're improving units, we're increasing our rent roll. So with this, you're gonna have to be a little bit more patient with cash flow, but the end result with the refinance can be much more profitable. Well, not much more, but decently more profitable. On a turnkey property, you could probably expect about a 40% of the refinance. With a real reposition like this, you're looking at about a 50% cash on cash return at the refinance. So if between cash flow and the refinance, if you add those both up, it is a total cash on cash return of about 65% for this property. That's over that 5-year period. We'll do another refinance around year 8. By that time, the investor will have made back their entire investment plus some. And of course, the investors can also exit at each refinance. But if you do that, you're going to have to pay income tax on the monies you've earned from the refinance and the cash flow. So a better tax strategy is to stay invested long term. And if you choose to do that, then you'll also take into account tax depreciation. So over this 5-year period, you would expect about 21% return from your tax depreciation. So our targets here would actually show that you'll get more tax depreciation than cash flow. That means you can write off all your cash flow and owe no income tax on that cash flow. Then we go to refinance. And let's say you invested $100,000 in this property, and you get a check for $49,000 of the refinance. Okay, that's our target. So in that case, that $49,000, if you do not exit the investment and stick with us through 1031 tax deference, essentially that $49,000 is tax-free money. The reason the cash from a cash out refinance is tax-free is because we're not selling the building, you're not exiting the investment, it's not cash flow, it's debt. It's debt that Seth and I will personally guarantee so our investors don't have to. But at the end of the day, it's debt. Now, it's good debt. It's a safe amount of debt at a low interest rate. The bank wouldn't give us the debt if the building didn't perform to that level. The bank underwrites the building. The bank wouldn't give Seth and I the debt if we didn't have $17 million in assets to back it up. And the bank's going to give us that debt at about a 3.75 interest rate, which is phenomenal. Historically speaking, phenomenal. The cost of money is at the same rate of inflation. That's a whole other presentation. But essentially borrowing money at around 3% is practically free. It's hard if you put it into an asset that keeps up with inflation. That's a whole other presentation. But the cost of money is so cheap right now. It's phenomenal. So, and rents are high, right? So it's really a perfect storm to be owning real estate, income real estate at least. And so with this opportunity, with the cash out refinance, the reason we do that is to avoid giving money to the government, avoid giving our money to the IRS. See, I started this business 12 years ago as a realtor, and I hustled my butt off. And by year 3, I made $150,000 as a realtor. And then I realized I owed the government like $30,000 or $40,000. And I didn't really have it because I was a young guy. I didn't really totally understand how much I would owe to the government. So I worked like 4 months out of the year just to pay the government. And I hated that. I hated it so much. I said, I'm not doing this anymore. My real passion is in owning real estate, not trading it. Being a broker is a great gig. Being a realtor is a great gig. I made a lot of money. I learned a lot about the business, but you really got to work hard for it. And you're working 7 days a week. And it wasn't the quality of life I was looking for. So my passion was always in owning the real estate. So I transitioned over time from being a realtor into being an investor. And trust me, there were days that went by. I said, boy, I missed that 150 grand a year being a realtor. Because when I sacrificed that, went out to focus my time on being an investor, you don't necessarily make that right off the bat. It takes time to make that, and certainly did. But I sacrificed that temporary income to get rid of that tax burden and build wealth. Now I pay myself easily over that, and I don't owe tax on it because I pay myself through refinance of real estate. Next week, I'm refinancing a property, and I'll take out about $100,000 from the refinance right into my bank account. That's debt. That's money I don't have to pay taxes on. Now, if I did a real estate transaction as a broker, a big one, and I made a $100,000 commission, awesome. Guess what? I owe 30,000 of that to the IRS, right? Depending on how much I can write off and all that good stuff. But for the most part, you're going to owe some of that, a large chunk of it to the IRS. So the bottom line is the more money you keep, less money you give to the government, the better off you are. Okay, case study number 2. 196 9th Street, Passaic, New Jersey. Nice, beautiful brick 6-unit here. Now, this is an interesting case study because a lot of syndicates don't bother with this stuff. They don't bother with a 6-unit. Most of them don't bother with anything less than 50 units. And I understand why. It's easier to do bigger properties and, economies of scale, more units under one roof. And we don't bother with anything below 6 units. If it's below 6 units, we flip it. That can be profitable as well. That's a different presentation. But if it's 6 units or more, we focus on buying, renovating, repositioning it, and refinancing, just as we explained in the last case study. So same strategy here. Again, great deals are created, not found. We talked to this owner for a long time. Seth Martinez was in touch with him through direct mail, and he was a big Mets fan. I'm a big Yankees fan, so I just kept my mouth shut. Rule number 1 negotiation. If you need to be a Mets fan, be a Mets fan. Because it made us lots of money. So at the end of the day, if you're a devout Yankees fan, fine. Okay. But in this case, I decided I was a Mets fan. So he's an old owner, retiring, ready to sell. Seth built rapport with him and negotiated a good deal over a few months. Again, no green card, low rents. Oh, by the way, a green card is a state-issued inspection that happens every 5 years for properties 3 units or larger in New Jersey. So if you own a 3-unit or larger property, and you don't know what a green card is, look into it. The state might be fining you right now for not getting your green card. So it's very confusing, green cards. The state won't tell you they're fining you, but then you call them up and you're like, yeah, you owe us 20 grand. And it's really a mess. So you have to know your green card situation with your property if you own a property that's 3 units or bigger in New Jersey. So that's always an issue. Whenever we're buying these properties from these really slumlords, they don't know how to manage the properties. They're mismanaged properties. They often don't have the green card or know anything about a green card, or they'll try and convince us properties don't need a green card. That's a good one. We like that one. And also the rents tend to be very low. The properties tend to need a lot of work, and that's what we like, right? We're looking for value add. That's called value add opportunity. Low rents, in need of cosmetic repairs, right? I don't want the place to be falling apart. I don't want holes in the roofs and none of the boilers work and everyone's a squatter. No, that's a mess. But I do like properties that are kind of turnkey with just low rents, need some cosmetic work. Maybe we need to get the state green card. And these things add up to enough headaches that the seller says, you know what, I'll sell it to you for 450 grand, which is what we bought this 6-unit for in Passaic, New Jersey. You know anything about the values of 6 families in Passaic, New Jersey, you'll know that $450,000 is a phenomenal deal. So 6 2-bedroom apartments. We own 55% of this property. Investors own 45%. That was a very favorable split for us. We normally don't do splits that favorable to us. On the 25 unit we bought in October, it was a 70-30 split. Our last case study, it was 68 or something. So more or less around a 60-40. So Usually it's more out of 60-40, 70-30, but this was such a good deal for such a good price. We were able to structure it this way and still get our investors the returns they were looking for. So here we did a total fundraise of $164,000. We created a Reg D 506C and filed with the SEC. We did a 506C for this opportunity because all the investors were accredited, where in the last opportunity, the investors were accredited and sophisticated, so we had to file a 506B. Seth and I personally guaranteed a mortgage of $337,000. And of course, we personally guaranteed that mortgage so our investors don't have to. Okay, here's the timeline to close and reposition. Okay, this project is also ahead of schedule. So in August of 2018, Seth connected with the owner. We did find him through direct mail, and $10,000 later, we had a good deal on the line, and Seth was able to connect with him and build rapport, start building rapport. By October 2018, we had the property under contract. Only 3-4 months later, not bad, and we put the property under contract for $450,000. Then, of course, we put the opportunity out to our investor pool, raised the capital very quickly for this one, and was able to proceed to closing. Then I think there was a little title issue that again slowed it up. Real estate closings are complicated. They tend to take a little longer than we think. And January 2019, we were able to close on the property and begin repositioning it, okay? About 2.5 years ago. So by March 2019, we completed our first successful cash for keys move out. So this building was fully occupied with tenants. And in New Jersey, you can't just buy a building and be like, oh, you pay a low rent, there's the door. It's not how it works. There's tenant landlord laws. It's completely unethical and illegal. And so you have to really come in with honey, with a smile on your face, with respect, and understanding that a lot of these tenants have been here perhaps longer than I've been on this earth. So we always come in with our best foot forward. These tenants are our customers after all, just like our investors are our clients, and our customers, our tenants are also our customer. We service them, they pay us, and that money trickles down to our investors. So it's very important that the first thing we do is treat our tenants right if we're going to treat our investors right. Because to get our investors the types of returns that we target, I need to get our tenants to cooperate. Whether that means us renovating the units and renegotiating to a higher rent price, or us discussing a cash for keys, which means we're going to pay them to move out, and we're going to help them maybe find a place or work with their timeline on moving out, or make sure they get their security deposit back, right? Whatever the situation is, to complete that cash for keys and vacate the unit. And that's part of our job, and it's difficult to do a cash for keys. So every scenario is different. We're very good at it. We've really done it enough times to get a really nice system down. And so we were able to negotiate very successful cash for keys here. So then by January 2021, we fully leased the property at the desired rental amount. So it was about a 2.5 year process. We thought it would take about 3 years. So we were able to get it done ahead of schedule. Okay, here's the reposition performance on this property. Here's the numbers. So our initial rent roll is $49.20. Our initial monthly rent roll is $4,920. Our target rent roll after 3 years was to get the monthly rent roll up to $7,300. Okay, pretty big jump. In 2.5 years, we were able to renegotiate leases, do cash for keys with tenants, renovate units, find out more ways to make income on the property through laundry and storage, and we were able to get our income and our rent roll up to $7,300 a month. So a huge increase in the rent roll. Now, our construction budget was light. We did go slightly over budget on construction. I think about $5,000 or so. And not a big issue. People's Capital Group comes in with a difference, not a problem. And our construction's on schedule. So we got everything done really ahead of schedule. And I think there's just a slight issue with a plumbing thing we didn't catch for buying. That's part of owning real estate. Things come up also while you own it. Things break while you own it that you didn't think would break. So that happens. And here we had 6% annual forced equity growth, and our target was achieved. So we wanted to force the value of the building up by 6% per year by lowering our expenses and increasing our income. And we were able to do that. So we achieved that target of 6% a year. And of course, we on this for Passaic, we assumed a 2% natural market appreciation. Now, the reason we assumed a 1.5% natural market appreciation in Patterson and a 2% natural market appreciation in Passaic is because Passaic is a bit of a nicer town and tends to grow at a higher rate. So we were wrong in both cases. Both towns have grown by 6 to 10% a year. It's been phenomenal. Now, we would never, ever project that long term. We still project a 1 to 2% annual growth on our properties. We assume the market's going to correct. We assume the market's just going to keep up with inflation. That's it. If the market does better than inflation, it's great for our investors, great for us. And that's what this business is all about, is under promising and over delivering, being really conservative off the bat, saying, listen, I don't have a crystal ball. I don't know how much property values are going to grow by for the next 5, 10, 15 years. Let's just assume that it's going to keep up with inflation as real estate has for the last 100 years. That's a pretty safe assumption then. Okay, let's assume it's going to keep doing what it's done for the last 100 years. And that's what we assume on our properties. Okay, total target returns for investors for years 1 to 5 for this property. Cash and cash return from the refinance was 53%. Okay, so if you invested $100,000, you would expect $53,000 of the refinance. The cash flow is 2%. And we were wrong. The cash flow is already more than that. So maybe we were too conservative on this deal. I guess we were. And that's good. That's a good problem to have. You know, we told our investor he would get 2% cash flow over a 5-year period. And he kind of, you know, that's really low. I know it's really low. The reason we're doing that is because we're assuming a 3-year turnover period. And we're assuming that we're going to have a lot of challenges here. And we're assuming we're really going to just break even for most of the time of ownership until the refinance. Maybe the last 2 years will produce cash flow. But so we were wrong. We're going to create a lot more cash flow than 2% over a 5-year period. And you have your tax depreciation, 11% over the 5-year period. Again, that can be sometimes, depending on the tax bracket and things like that, a little different. But, so overall, we have an internal rate of return of 66% on the investment here. An internal rate of return takes into account your tax benefits, your cash flow, and your cash from refinance. The total cash on cash return just takes into account your cash flow and your cash from the refinance. So your total cash on cash return is a target of 55%. I think we're going to do better than that because of our cash flow is going to be better than we targeted. So here's the revenue model. It's really simple. We produce quarterly cash flow for our investors with quarterly financials as well. That's always the target. Monthly updates, also in-depth monthly updates on what's going on with the property that educate our investors along the way. Annual tax depreciation is given out through a K-1 at the end of the year. All of our investors receive a K-1 tax form at the end of the year because they own part of the real estate. They're passive owners, non-voting members of the LLC that owns the real estate. So they get that tax depreciation just like any real estate owner does. And of course, we have the 4 to 5 year cash out refinance goal, and we're going to do that every 4 to 5 years. And that's going to allow the investors the exit option as well. And of course, the large lump sum of tax-free capital if you stay invested long-term with us. And that's why we do the buy, renovate, refinance strategy. It's a tax strategy. It's a way to keep more of your money, not give it to the IRS, and therefore ideally be able to reinvest and build your assets greater over time. I don't know if you've ever seen a chart that shows if you get taxed along the way or if you don't get taxed along the way, like an IRA or something. It's incredible how much more your wealth will grow over a period of time if you don't have to pay taxes on the growth of that wealth. So really focus on that strategy of not paying taxes or paying as little tax as possible. Of course, always follow the tax law, but play within the law. And the law is there to benefit real estate owners. So take advantage of that by owning real estate. Okay, so why now? Why now is a perfect time to buy real estate? In my opinion, rents are growing. Well, not my opinion. The facts are rents are growing. Interest rates are low. Property values are growing. There's a shortage of housing. There's a real shortage of housing. People need a roof over their head. We really didn't build much housing through the pandemic. They haven't really been building enough housing to keep up with the demand in North Jersey. You know, it's definitely, you know, it's all over the news, shortage of houses. So housing demand is growing, right? Housing prices, how high are they going to go, right? That's because there's not enough housing. and interest rates are low, and that needs to change because that's kind of artificially inflating the market as well. But even if interest rates raise, we're still in a good position on our properties with strong cash flow and strong value. Even if values drop, we buy properties for cash flow and for value, but we also buy properties that allow for cash flow. So if values drop, that may cause us to do a lesser of a cash out refinance, but then values will come back over time, and maybe the second refinance is going to make up for the difference. So over a long period of time, real estate tends to, of course, have its ups and downs, but it's very tried and true. And in my experience, it's really been an incredible asset for me and my family. It's been able to allow me to create an income that I've avoided. I don't have to pay taxes on the income, which is really phenomenal the way I pay myself and our investors. And that's a nice feeling when you're able to own assets that you're proud of, that are professionally managed and produce cash flow and refinance capital that doesn't get taxed by the IRS, or you can write it off with the tax depreciation. And that's a really nice feeling. You feel like you're almost smarter than the IRS, but not quite. You're just following their rules, quite frankly, and that's the right thing to do, is follow the rules and play the tax game the best way you can. So here's a little bit about investing with your IRA. We're going to wrap up here. We got about 10 more minutes here. Again, if you have any questions as we go along, type them in the Q&A. So we work with about a third of our investors. We have about 50 investors that work with us, and about 90% of them reinvest over time, and about a third of them use their IRA. So they'll self-direct their IRA into real estate. I see a question just pop up. That's fine. Keep them coming. We also work with solo 401ks as well. So you can do a solo 401k, or you can self-direct your IRA into real estate. I'm not going to break into it a ton right now, but essentially you're going to hire an IRA custodian, select one. There's tons of them out there. I can even put you in touch with a consultant who can help you find the right IRA custodian for you. Select an IRA custodian. They're going to call whoever has your IRA right now. Let's say Fidelity. Fidelity is going to move it over to your IRA custodian. Your IRA custodian is going to review the offering memorandum, the operating agreement, the details of the investment opportunity you decide to proceed with, say an opportunity with People's Capital Group. They're going to review the opportunity, make sure it's IRA friendly. Okay, they don't advise you on if it's a good opportunity or if they like Aaron or don't like Seth or whatever. They just advise you on if it's IRA friendly, and then they say if it is or isn't. Of course, our opportunities are IRA friendly. They are solo 401k friendly. That means you can invest through an IRA or solo 401k in our opportunities. And about a third of our investors use that tool. So we're going to go over quick the types of people we work with. Okay, we work with accredited investors. That's one of them. That's a high income investor. That's an individual with a net worth of over $1 million, not including their primary residence, or has an income of $250,000 or $300,000, including their spouse. Okay, high income investors, accredited investors tend to have large stock portfolios that produce dividends. We feel that the stock market long term is less predictable than real estate and more volatile. It's good to be diversified over time, but if all your capital is in the stock market, then that's really not diversification. It really should be in some brick and mortar, professionally managed real estate. We feel real estate's a little more recession resilient, and we've seen especially commercial buildings like apartment buildings and high demand markets and things like that. The value of your home, it's going to fluctuate a little bit more, but apartment buildings, high demand commercial real estate tend to hold its value pretty nicely. I think 2008 was a bit of an anomaly. I don't think we're going to see that type of situation again here anytime soon. But we do feel like they hold their value stronger during the recession. And of course, real estate produces cash flow. We try to get a quarterly cash flow check to our investors, tax depreciation. And that's the big difference between stocks, right? Stocks don't offer tax depreciation where real estate does. Another type of real investor we work with is an active real estate investor. This might be someone that owns properties and is managing them or managing a management company. They're getting tired of managing the management company. They're always on call. Maybe they're limited to buying smaller properties because they're not pooling their capital together and buying larger properties that have the advantage of economies of scale. And of course, tax time is a big headache. So what we do at People's Capital Group is we work with those active investors because we also wholesale properties, we flip properties. Seth and I have done 250 plus transactions together. So we've done a lot of different types of deals, and we're a lot of different types of investors. And a lot of times they'll come back and say, hey, what do you have as a passive investment? You know, I'm just looking to self-direct an IRA, or I just flipped a house and coming out of a deal, I have some excess cash. And So we'll put them into a syndicate, an opportunity with us, and they really like the difference of not being on call, not having to manage the management company, not having to personally guarantee the mortgage. Getting into a bigger building for still a smaller investment. You can own part of a 25-unit property for a $30,000 investment in North Jersey, where normally you would not be able to buy a 25-unit property with $30,000 in North Jersey. So by pooling capital together, investing in a syndicate, take advantage of economies of scale. And of course, tax time is a lot less painful because our CPA does all the tax prep and K-1 deliverance to our investors and bookkeeping for our assets here, for the investments for our investors, the investments with People's Capital Group. The third type of investor we work with is the IRA investor or solo 401k. This is an individual that's trying to diversify out of the stock market. We do suggest that 30 to 50% of your investment should be in real estate, or at least outside the stock market, not just rolling with index funds. If we've seen anything in the last year with the pandemic, it's that when everyone gets spooked, the first thing to drop tends to be the stock market. And it also came roaring back. So listen, you could do well with the stock market, right? It's done very well this year, but you really want to diversify. That's the bottom line. Sometimes it feels like you're playing musical chairs with the stock market. I feel like commercial brick and mortar real estate that produces cash flow is a little more predictable and a good place to be diversified into. And one of the real reasons we like it too is the local community, investing in the inner city areas, improving local communities. IRA investors, or all of our investors, really like that. Newark, Patterson, Passaic, these cities need improvement. These cities need investment. We do it brick by buying buildings, improving them. Sometimes they have really problem tenants in there, drug dealers and things like that. We make it a family-friendly environment where people feel safe going. People like bringing their friends there, and they feel safe raising their children there. And we improve these buildings, and that improves these cities little by little. And that's a nice thing to see. It's a nice tangible effect of your capital. And I love that about my job. I really do. So here's some financial transforming praise. Tim Carey, 5-time investor. I continue to grow my investing relationship with People's Capital Group. They have a great history of buying properties at a good price and offering value. Frank Macuzzi, 4-time investor. My investments have been on point. I like not having to manage the properties. Chris Salerno, 6-time investor. I've been investing with People's Capital Group for nearly 5 years now and cannot be happier with the process and the returns on my investment. Aaron, Seth, and the rest of the crew are fantastic to work with. They're like clockwork in their updates, communications, and payments. A great company to work with. So again, about 90% of our investors reinvest over time. Some use their IRA, some just invest capital. But if you're curious about the process to get qualified, go to peoplescapitalgroup.com. Okay, and I'll show you our website here, peoplescapitalgroup.com. It's got all the our podcasts on it as well. You can check out over 50 podcast episodes. You can check out past webinars on how to self-direct your IRA or how to diversify out of the stock market. We even have properties for sale as well. But I'll be honest, if it's a really good deal, we're going to scoop it up with our investment group. If it's over 6 units and makes sense with value add, we're going to buy it ourselves. If it's something less than that, we're going to possibly wholesale it and put it on our property for sale there. But if you do want to move to the next step, if you are curious about how to get qualified, do you qualify, click this button here, go to peoplescapitalgroup.com and click the button that says schedule discovery call. And that's going to bring you to our application here. You can fill this out. We do need to collect some financial information about you. Nothing like your social security number or anything like that. Just we need to understand how much you're earning, what your net worth is. The SEC actually requires us to do this. Are you married, right? Your address. We have to know this to talk to you about an investment opportunity. I can't explain an investment opportunity in depth to you if you're not qualified, if you're not a sophisticated or accredited investor. Now, I explained what a accredited investor is, and if you don't quite make that cut financially, you may fall into the category of the sophisticated investor. Now, that's someone that has the minimum investment amount of $30,000, doesn't need to live on the returns of the investment, meaning they have excess savings, maybe another $50,000. They also have some experience. Maybe they bought a home, maybe they own an income property, and they understand the opportunity, meaning they filled out the form here. I've reviewed the form. They scheduled a call with me. We do the call. We review the opportunity that's available right then, or they get on the list and we're going to send them the next opportunity when we have it. And that's how you get qualified. So you do have to go to peoplescapitalgroup.com, fill out the qualification form, It should only take you a couple minutes. Then you're going to click the next button to schedule a call, and that'll prompt you to schedule a call with a managing member of People's Capital Group. Most of the time, that's going to be me, Aaron Fragnito. We'll be able to connect on the phone through our scheduled call for about 15 minutes, get to know each other, build some rapport, answer your questions, and I'll talk to you about what we have available at that time. Our last opportunity got funded in 7 days. The opportunity before that got funded much faster. So don't wait to see that email or that Facebook post. Go to our website now, fill out the form, get qualified, get on our list, schedule the call. And when we have that next opportunity, what's good, it's going to be in the next couple of weeks now, you're going to get the jump on that. So don't delay and go there. You can take that step this evening. All right, I'm going to answer some questions here now. What's the easiest way to get in touch with People's Capital Group? Well, I think we answered that there. Yeah, you go to peoplescapitalgroup.com. If you fill out the application form or you're going to schedule your call with me, that's the best way to do it. So go to peoplescapitalgroup.com, and I'll give you the link right here to this this website, our website here. And then that'll give you the fast track to schedule a call with me. I do need you to fill out the form before you schedule a call with me. So just go through that process, and that way I'll know if you're qualified or not. And I'll still take the call even if you're not qualified sometimes, just to kind of go over the process to get you to the qualification level if we feel that you're close. So if you're not sure if you qualify, or you just want to you do know you're going to qualify and going to get out of that list, go ahead and fill out that form. Let's see if there's any other questions here. All right, so I don't see any other questions here. I'll leave this screen up for you to take a look. And you can also email us at info@peoplescapitalgroup.com. You can call us at our phone number there. The best way to schedule your call is go to peoplescapitalgroup.com. That's it for tonight, ladies and gentlemen. I hope you enjoyed the presentation. We covered 2 case studies, and you can go to our website for our next webinar as well to schedule for that. Have a good night.